Nigeria's inflation rate in the month of June surged further to 18.6%, the highest level in over 5 years. Ifeoma Onyejekwe, fixed income trader at UBA, joins me for this discussion and an update on activities at the fixed income market. Ifeoma, thank you so much. Pleasure to have you on the show today.
Thank you for having me, Esther.
As you have seen yourself, we just recorded a 5-year high for inflation rate coming in at 18.6%. How is the market adjusting these latest inflation numbers?
Well, to be honest, we've not seen as much reaction in the markets as expected. That's because there has been issues with system liquidity. Even at the auction on Wednesday, the NTB auction, we saw subscription rates almost at par with what was offered and what was sold. So the market hasn't really seen a lot of reactions, but going into H1, would likely see investors demand for more at the bond and also treasury bills auction, as well as in secondary market during trading.
At the last auction, we did see the 1-year paper go up to 7%, I believe.
Yeah.
I mean, can we take a clue from this in terms of that this could, we could see a climb upwards going forward?
Oh, definitely. I believe we can. Investors will definitely ask for more to compensate for market risk as well as inflation rates. So we can definitely expect more increases in yields.
Let's talk about the government, DMO borrowing activities at the domestic market. I was having a conversation, I believe it was yesterday, on the Eurobond market and where rates are right now. Nigeria's a Eurobond and Nigeria's chances of going back to the Eurobond market and the kind of interest rates that the government could potentially face. I'm being told between 12 and even as high as 14%. So that's a no-go right now for the government. So obviously, the government will be looking inwards more at the domestic market. What does this mean in terms of where rates could go as a result of that? And investors knowing that, the government is looking inwards for more borrowing at the domestic market.
Well, we can definitely expect rates to rise up to double-digit levels, and in the forthcoming bond auction on Monday, I will not be surprised to see rates climb as high as 14 levels. It closed last week at 13 levels. So yes, we'll definitely expect more increases in rates as we move into H2.
Was this part of your forecast for the beginning? I know it's difficult, many times to predict, the market trajectory. Obviously depends on, developing events. For instance, the Eurobond market, I'm not sure many predicted, that, interest rates could go as high as perhaps the announcement by global central banks of, multiple rate increases was perhaps a clue for everyone, but I suppose maybe not to this extent. And speaking about that, the U.S. is also planning a major rate increase. How is the market also, digesting that information vis-a-vis, rates here domestically?
Yeah, so we'll definitely see investors dump more local currency securities for foreign currency securities, since it gives them, better interest rates for them. So yes, and that will also, add to the yield increases we would expect. But yes, at the beginning of the year, so many things were not, expected. We didn't expect for the Russia and Ukraine war. We did not expect, these huge persistent force shortages, as well as, the surging diesel costs. So many things were not accounted for. So yes, some things definitely took the market by surprise. But going forward, we will see more demand for better yields by investors, and also it's very likely that at the forthcoming NBC meeting on the 25th and 26th, we'll also see our CBN likely raise, MPR.
What's it like? Quick question: what's it been like for corporates who have been raising cash at the market, commercial papers? Of course, looking at the benchmark from the other side of the market, what's it been like for those corporates?
It's been very difficult. We've not seen as much we've not seen many corporates coming to raise commercial papers like we saw last year. So yes, it's been a very, very tight market for them.